Hello, AP Microeconomics. Welcome to Chapter 9, Perfect Competition. A few things that we're going to look at here is we're going to look at, throughout these next few chapters, chapters 9, 14, 15, and 16, we're going to look at perfect competition. We're going to look at monopoly, which is chapter 14. We're going to look at oligopolies, which is chapter 15. And then monopolistic competition. We'll spend about 4 or 5 days on perfect competition. Monopoly, we'll spend another 4 or 5 days. We'll spend about 2 days on oligopolies and maybe 1 day on monopolistic competition, 1 to 1.5 days. These are the 5 main concepts throughout the next 4 chapters. It is going to be vital that you understand what each of these is and how to actually calculate them, figure them out, identify them. Because the key thing is, if you can figure out what each of these 5 categories are, price, quantity, profit, efficiency, and overall surplus, if you can nail those 5 concepts across all 4 of these market structures, you'll greatly enhance your success over these next 4 chapters. So here's some of our previous learning that we're going to use in this chapter 9 and then also 14, 15, and 16. But let's just focus on chapter 9. Some of the previous learning that we're going to do includes movements of the supply and demand and the impact on price and quantity. Secondly, is going to be we're going to bring back the determinants of elasticity of demand. So we're going to see how the elasticity of demand changes throughout these market structures. And we're going to look at economic profit. We're going to figure out again, how do we calculate economic profit? Looking at, do we have a profit? Do we have zero profit, a normal profit? What do we have? We'll look at optimal quantity again. We'll try to figure out in each of these 4 market structures what our optimal quantity actually is to maximize profit, because that's going to be our main goal going forward. And we're also going to talk about the law of diminishing marginal returns and what that has to do or deal with the next 4 chapters, along with our short-run production costs, right? So we'll take the marginal cost A, B, C, and ATC, and we'll do that a whole bunch of different ways to help us understand the price, the output, the profit, the efficiency, things of that nature. So we'll bring all of these topics into these next 4 chapters. So here's what we're going to learn. Here's what you're going to learn in chapter 9. We're going to focus on perfect competition. And again, with these market structures, the 4 market structures, these aren't talking about different types of industries, but they're talking about different types of market structures. Within each market structure, there may be different industries and then also different businesses, but we're going to focus on just what the market looks like as a whole, not just by business or industry by industry, but as a market, okay? So here's what we're going to learn. In perfect competition that earns an economic profit, this is how we're going to draw it by the time that we're done. The first thing that we have to do is you're going to see that we have a supply and demand curve. This is where the market equilibrium price and quantity is going to be established. And then we are going to have a dotted line, because in perfect competition, we're going to understand that each of the firms that are producing in perfect competition, they get their price from the industry. So this is going to be our new price line for the perfectly competitive firms. And then what we do is we have to add in our short-run production costs. And as we've talked about before, now we no longer need to add the AFC in, because we know that there is a difference. This is the short run, because we have a difference between ATC and ABC. And so what we'll figure out is we're going to take, this is where our optimal quantity is going to be as we look at perfect competition for each firm. And then this is going to be established where my price, which also is going to be considered MR, which is marginal revenue, which we'll talk about that a little bit more in a few minutes. And then how do we find profit? We have to take the difference between our price down to our ATC, because remember, ATC represents the average cost per unit. The price represents the average price per unit. And we're going to go back over here. We're going to shade this in, and we're going to say this is what our economic profit actually is in perfect competition. This is perfect competition in the short run, right? Now, in the short run, we know that businesses, we're going to learn later on that in the short run for perfect competition, businesses have to either earn a profit or a loss. And then in the long run, we have to look at it differently. We still have our supply and demand curve. We still have our industry price. We have our industry quantity. Well, we are going to establish a new price line and a marginal revenue. But what's different about this is that in the long run, we are going to figure out that the actual quantity, the optimal quantity, is going to be at the minimum point of our ATC, right? So this is kind of a sneak peek into what we will do over these next few videos that introduce Chapter 9 and perfect competition. So let's go ahead and we'll get rid of this. Hopefully that squeaking isn't coming through quite as much as it is here. All right, so here's how we have to figure out what perfect competition actually is. Right? What perfect competition actually is we have to look at how many sellers a firm has, what their price making ability is, and things such as that. Is there free entry, free exit to industries? So each of our market structures are going to have these four. They're going to have 4 categories. And we're going to break it down for each market structure. We're going to break down what specifically is true for each of the market structures. So perfect competition. We have thousands of sellers that they're all the same exact size. Now, before I get too far, here's what I really want to explain. Perfect competition doesn't really exist. In Chapter 14, pure monopolies don't really exist in the U.S., right? So you may ask, well, why are we spending time focusing on it? Because when we look at the majority of businesses that are either oligopolistic or monopolistic competition, which are chapters 15 and 16, each of them takes part of something from perfect competition and something from pure monopoly. So we use these as our basis tools, our foundation, to understand what all of the 4 market structures are. So perfect competition, again, doesn't really exist. And you probably can tell that by looking at here. Is there an industry that you can name that has thousands of sellers that are the same exact size? And that's your giveaway right away that, well, this doesn't sound like reality. Well, you'd be correct because it's not reality. All right, so the second thing that we have are the different types of products. And in perfect competition, we have one type of product, and it's called a standardized or homogeneous product. And what standardized or homogeneous means, that means every single one of these firms that are the same exact size sells the same exact product. So if something is homogeneous, it means that every single product that they sell is exactly the same. And that's another kind of giveaway for us that it really doesn't exist. We will look at examples later on that the agricultural industry in the U.S. is the closest thing that we can use to compare to perfect competition. The third thing that we look at is price making ability. So what we're talking about is what kind of ability do each of these firms have to actually set their own price? And what we find out in perfect competition is that they are called price takers. And what a price taker means is that they have such low market share that they have zero impact on the actual price, which means there's nothing that the firm can do to actually influence price. That firm can increase its production, they can double their production. They're so small and minuscule because there are thousands of firms in this industry that there's nothing that one firm can do to actually influence the price. It's another one of those examples that this doesn't really exist because every firm, every real business we have can do certain things to influence the pricing in an industry. And we'll look at those a little bit later on. So being a price taker, this is what if you refer back a few minutes when we talked about when I graphed these things for you, what it actually meant is that when I was graphing the supply and demand curve first, and then I actually did the dotted line over for each of the firms, I did that because each firm has to take the price from the market's supply and demand. And so that's what we'll get into some more detail a little bit later on. The fourth piece is entry and exit from an industry, or entry into or exit from. And so remember, these four categories are going to be the same categories for each of our market structures, but every market structure is going to have different details underneath these. And so again, we have to understand what we're talking about with each of these four to make it so you have transferable learning throughout the next few chapters. So entry into and exit from an industry. What we're talking about in perfect competition is that these firms, it has free entry and free exit, meaning there's very low barriers to entry. Now, this is a new term for us, and we're not going to define it right now. We'll define it a lot more as we get into chapter 14. But a barrier to entry is something that would prevent a firm from entering into an industry, such as maybe really huge fixed costs, like to get into the airline industry. It's really difficult to compete with Boeing and Airbus because they have such huge economies of scale. It's really hard for me to be a new supplier or a new manufacturer in this industry. So in perfect competition, there's free entry and free exit. Nothing is preventing firms from coming in, and nothing is preventing firms from going out. And that will be really important. This factor will be really important when we talk about perfect competition in the long run, right? So right now it's not quite as important, but it will be later on when we get into the second or the third video. All right, so these are our four. So when we look at a couple different examples, the closest example here that we have a perfect competition would be agriculture or farming. Because if you think about with farming, the reason why farming is, and I'll talk about why these two aren't considered perfect competition. Farming is considered perfect competition because let's just say that you take one specific strain of corn. Well, we do have hundreds, maybe even thousands of farmers that sell this specific corn. And when they sell this corn, they actually sell it at a market price. Well, the market price is actually established on the commodities market. So there's an exchange in Chicago called the Chicago Mercantile Exchange, which basically, but you can buy and sell in commodities. Very similar to like the stock exchange. In the stock exchange, you buy and sell stocks. Like the price of a stock is set by a market, right? And so everyone who wants to buy that or sell it, they have to take the prices given them by the market. Well, the same thing in perfect competition for farmers. So farmers, when they want to go to the market and they want to sell their corn at the current market price, that was established by a market, wherever the supply and demand intersected. So why are these two not considered close to perfect competition? Well, Verizon, first off, the communications industry does not have thousands of sellers in it. So there's only really a handful of communication companies, Verizon, T-Mobile, AT&T, that really compete in that industry. But they really sell the same exact thing. They're selling you connectivity on your phone. And so what's different is the actual data plans and what the services are along with that. But at the root of it, what they actually sell is the same exact thing. So that's how it could be considered perfect competition, because they sell a homogeneous product, kind of. But there's only a handful of businesses. Here, there are a bunch of businesses that compete with McDonald's, but not thousands. And every single restaurant that competes with McDonald's sells a different type of burger. You know, McDonald's has the Big Mac, and Burger King has the Whopper, right? And so they have all these different types. And so that's called a differentiated product. So the type of product is different from McDonald's, but they have many sellers, but not thousands. So this is kind of a way for you to kind of apply this and know, what are we looking at with perfect competition? We're going to focus more on our farming example. So what we look at here is we're going to figure out what the price and demand are in a perfectly competitive market or industry. So when I say a market, I'm talking about an industry as well. So we'll focus on the word market. So how is price determined in a market? Well, if you look at price in a market, price is determined by the intersection of supply and demand. So this is when in chapter 3, when you learned about supply demand, we were talking about the market supply demand for a good. So the supply and demand of a good in a market. And so the actual price in that market is established by the intersection of supply and demand. Here's the industry price, and here's the industry quantity. So we're just bringing up stuff from chapter 3, and then we're going to be applying it and seeing how it applies to perfect competition. Well, we can see right away that if you go back and think about this, think about in perfect competition, we talked about the demand curve being similar to our marginal benefit. And marginal benefit is downward sloping because of diminishing marginal utility, right? So hopefully that's not new. That's a refresher for you. The supply curve, we can look at the supply curve and say that's similar to marginal cost. So when we look at the intersection of marginal cost and marginal benefit, if this is the quantity that we established, since we're producing the amount of goods where marginal benefit equals marginal cost in this perfectly competitive market, that means that in perfect competition, we're always going to be allocatively efficient. So if you remember earlier on, I said some businesses we're going to talk about are going to be allocatively efficient and some aren't. This is one of those examples that perfect competition is always going to be allocatively efficient because we're producing at the equilibrium quantity where our marginal benefit really equals our marginal cost, right? So now when we look at the last piece, remember that allocative efficiency really talked about the marginal cost of the last unit, which is right here, is equal to what is demanded by society. Well, our marginal benefit is our demand, and so when both of those equal, that means we're producing the allocative efficient quantity, which in this case I've mentioned before. When you see here, remember when I had the marginal benefit right here? Our demand curve looks exactly like and acts exactly like a marginal benefit curve. So that marginal benefit curve is our demand curve. So where marginal cost equals demand, if my quantity is there, now I'm allocatively efficient, okay? So when we look at what does the price and demand curve look like for each of the firms? Well, when we think about that, what does the demand curve look like for each firm? Well, the firm, because they are a price taker, which is one of the characteristics, because they're a price taker, what it means for them is that there is the price for itself is set at the market equilibrium, and so each firm is a price taker. So each firm has to take that price from the actual industry, which creates what you see right here. It creates this is my industry or my market. This is the supply and demand. Here's what my price is in the industry. Here's my industry quantity. And when you look at how it impacts the firm, well, this price continues all the way through here. If every single firm has to sell their goods, at the same price that the market established, well, that creates a perfectly elastic demand curve. So the demand curve for the industry is downward sloping because we have to abide by the law of demand. But once you see perfect competition as a price taker, well, they aren't a price taker anymore because now they aren't establishing their own price. Each firm has to take the price from the industry, and so every single firm can only sell their product at that price. Well, that means that's what the demand is. So firms are able to, every buyer of the product from this, they are only willing to pay the price that is established. So in essence of this, if you are a stock market person, if you know that the price of Apple, let's say, is $250 for one stock of Apple, well, you don't go in saying, hey, I'll pay $275, because there's no, you wouldn't want to do that. I mean, people would want to sell it to you, but if I know that I can buy a whole bunch of stock for $250, I'm not willing to spend $275 because I know every other seller is selling it for $250. All right, so let's go on and continue through this. And so now with this, what we've established for a perfectly competitive firm, we've established that the price for a perfectly competitive firm was given or taken from the market or the industry, and the demand curve for every single firm is perfectly elastic. So that price equals the demand right away because they have to take that price from the industry. All right, so anytime throughout this video, as you're watching it, anytime throughout this video, you may decide to say, oh, I don't know what he said. Feel free, hey, rewind, stop it, pause it, think about it, go back to make sure that it's making sense before you keep going on. All right, so we'll go back to the piece. So let's look at this demand curve. So if your demand curve, if the price is set above the demand, well, remember what that basically means is that if your price is above your demand curve, there is no demand for it. And remember what that looked like. When we had our supply and a demand curve, if we wanted to charge a price in this area, there was no surplus in there. Why? Because it's beyond what people are willing to spend. Well, if you take that and apply that to perfect competition, if this is what the demand is for every single firm, if this is the demand, then there is going to be zero demand above that line because it's more than what anyone else is willing to pay, because every buyer knows that every seller is going to sell it for that market price. Because remember, every seller is the same size and they're selling the same exact thing. And again, that's why it doesn't really make sense. It's not really realities. We know that not all of our sellers sell the same exact thing. So if we look at the next piece, as we look at here, no consumer, this is what I just kind of explained, but no consumer would pay more than the lowest available price, where that demand curve is. So that a firm charges more than its competitors would get zero sale because there's no demand for it above there. If the price was set below the demand, well, there'd be an infinite quantity demanded. But if I'm a business and I know I can get $4.50 per bushel, why would I want to sell it? If I can sell every single thing for $4.50, why would I want to sell it less than that? Because I know I can sell it all at $4.50. So it doesn't make sense for me to say, oh, you know what? I'm going to beat my competitors and sell more than them, and I'm going to price it at $4. Well, it doesn't make any sense because I know every single buyer I can get $4.50 because that's what the market actually means. That's kind of a big piece to be able to walk away with. So firms need not charge less than the equilibrium price since they can sell all they want at the equilibrium price, right? So again, as I go through, if I go through too quickly, pause your video to give yourself some time to actually get some of this information. So now let's look at price equaling demand. Excuse me. Why does price equal demand? Well, as we think about, let's kind of break this down. The price is really what consumers are willing to pay for something. That's what a price is. Well, a demand is also what consumers are willing to pay for something. So both of them represent the same thing. And if I show you this, and I showed you that supply and a demand curve again, and I said, where is the price set? Well, anytime that we were to change our supply curve, my price increased to whatever the demand curve was. And if I was to get rid of this one here, if I was to shift my demand curve this way, well, I have a new price set here. The price is always set on that demand curve, and the reason is because both of them represent what consumers are willing to buy. So what you have to see going forward is when we showed you the image of what you have the price and a demand, what the price looks like in a market, and then each firm takes it. Well, that dotted line for each firm was your price and your demand curve. So we look at that. Your price is always set on the demand curve. Everything that we do from here on out is going to be the case unless the government steps in and does a price ceiling or a price floor, or if our government does a quota. Right? So, but we're not going to talk as much about chapter 4 in these videos. We're not going to introduce ceilings and floors again the rest of the time. We'll focus on what markets and actual industries actually do. So here's the kicker. All right, so this is where we get into the big information. What is marginal revenue? Because we haven't really talked about marginal revenue. I've introduced it a couple times, but we have to think about what marginal revenue is. Marginal revenue is the change in total revenue generated from an additional unit of output. So if you're thinking, hey, that sounds kind of familiar. Marginal product is the change in product when we generated from hiring an additional labor. Marginal cost is the change in total cost when we make one more product. Marginal revenue is the change in total revenue generated from making one more product. So we're going to be really focusing on marginal revenue and marginal cost. And that's where our optimal quantity is really going to be. Huge. If I had like a beeping sound, a siren sound, or like some lights, I'd really have these going off right now because this is a really key thing about perfect competition and the next 3 chapters after that. So this is how we calculate marginal revenue. Marginal revenue is the change in total revenue over the change in output. Right? So I'll let you get that down. So in the end, this is a different way of saying it. I'm going to go on. If you want to pause your video to get this in your notes, feel free to do that. Okay, here's where we start doing some calculations. All right, and so it's hard for you. You may not, if you on the slideshow, the colors come through a little bit better, but on this one here, it doesn't come through quite as much. So what we're going to do is we're going to do the calculations behind this, and then afterwards I'll show you what the key is. You kind of saw a sneak peek of it because I kind of clicked ahead by accident. Let's say if the price for something, you want to sell one thing, and the price for perfect competition is $10. I'm going to ask you a question, and I want you to pause the video and then be able to answer that question, right? So if I'm perfect competition, I chart the price that I can sell my first product for. The question is how much can you sell the second product for? And the third product, and the fourth product, right? So if you need to think about it, pause the video. If you know what the answer is, I'm just going to keep going. Since this is perfect competition and you are a price taker, you're able to sell every single product for the same exact price. 10, 10, 10, 10. And again, the reason is because I'm perfect competition and I am a price taker. So every single product that I sell is the same exact price. Well, now we just have to do calculations. And so you have this in your notes. And so as to do the calculations, this is $10. And so you just basically have to multiply these because price times quantity equals total revenue. We've talked about that before, and now we're coming back again. How do we find total revenue? We take price times quantity. So this is 20, 30, and then 40. Right? So once you see 10, 20, 30, 40, I want to find out what is my marginal revenue. So how much additional revenue did I generate by making one more product? Well, the difference between making 0 and 1 was 10 because I went from 0 to 10. Going from 10 to 20 is 10. Going from 20 to 30 is 10. Now you may be sitting back and thinking, oh, this is easy math. Exactly. The math is easy, but what's difficult for you is being able to understand what the relationship is. And at the very end, we're going to give you kind of that big learning piece for this first video about what perfect competition is. So if you don't have an average revenue column on your notes packet, just please add that. I don't remember if I have it in there for you. And so marginal revenue again is our change in total revenue over the change in quantity of output. So this only changed by 1 each time, so it makes the math easy. And if you can see what we end up doing here. I plotted the marginal in between these lines because technically when you plot a marginal, you should put it, you should kind of put it in between the numbers because it's going from 1 to 2 and then from 2 to 3. In the end, if I get rid of these and I get rid of this space right here, when you do this in different kind of calculations, it is not a big deal if you do it like that. You don't have to do it between. I'm just kind of showing you the technical way to do it. And now we figured out my price is $10. My price is $10. And remember, price is the same exact thing as your demand curve. Price equals demand, right? So now we have price and the demand are both 10. Marginal revenue is 10. And if you haven't already done the calculations, you can do the calculations for average revenue. Average revenue, 10 divided by 1. This is total revenue divided by quantity. And then 20 divided by 2. 30 by 3. 40 by 4. Right? And so this is where, when I said at the very bottom, pause video to complete this table in your notes with your learning. And so if you can do that, if you did that, or if you did it along with me, doesn't really matter. This is the piece. And so what I want you to do is I'm going to ask you a question. Again, I want you to pause the video to see, do you know what the answer is? What do you see your conclusion is about perfect competition, about the relationship between price, demand, marginal revenue, and average revenue? Pause. Well, here's the answer. If you look at this, this is 10. All of these are 10. All of these are 10. And all of these are 10. Which means the relationship between each of these is that one of the big learnings from the day is the fact that the relationship between all 4 of those is that they are all equal. And I'll give you some more details and more background about why that is. So hopefully that makes sense for you. And again, it's all because perfect competition is a price taker. Since they're taking the price from the industry, their price is never going to change. It's going to be the same amount for every single one, right? So this is the calculations again as we did this. And as you see down here, we proved that price equals demand, that equals MR, that equals AR. And so we'll look at a little bit more detail about what does that really mean for us? Well, as we look at this, here's what we can see. This is, I think I said the other day that, we no longer going to look at total revenue again. And I'm just using it as an illustration. You don't have to really worry about it too much going forward. But if we have, this is our industry, and if this is what it is for every single firm, what you find is that we set my price and we set a quantity in the industry. Well, since I'm a price taker, every firm has to take the price at $131. So this price is $31 and the demand curve is $131. And since I sell every single product for the same exact price, the marginal revenue is $131 and the average revenue is $131. Okay, so if I look at what happens to your total revenue curve, if you think about marginal cost look like this. And so total cost look like this. Well, the reason why total cost here is not a perfectly elastic line is because marginal cost is curved. It has a curve to it. But if you look at if your price or if your marginal revenue is a perfectly elastic line, you're adding $131 to total revenue every single time. And if you do that, the curve is linear. There's no curve, there's no increase at an increasing rate, increasing at a decreasing rate, so that makes it a little bit easier. All right, so again, we look at these different pieces, and so here's our conclusions about this first part of it. The conclusions at the very end, we have price equals the demand. And we know that price is constant since the firm is a price taker. Your total revenue increases. I think I'm missing an arrow here. I think it comes at the end. Total revenue is increasing at a constant rate since price is constant and the marginal revenue is constant. My marginal revenue is perfectly elastic because the revenue changes by the same exact price every single time. And then my average revenue is perfectly elastic since your price is constant. So in the end, price equals demand, that equals MR, that equals AR. And you can see at the very bottom there's something called Mr. DARP. This is a weird thing. There are some people out there that use this as a memory tool to remember in perfect competition the relationship between those four things. And if you think about Mr. DARP, the MR, the demand, the average revenue, and price. Mr. DARP is what the relationship is between those four things. All right, so we're almost through the first video. And if we look at this, a couple more steps that we have to do. So again, if you need to pause, to think, to add your notes, go ahead and do that. But in the video, I'm just going to keep going. So the price effect, if you remember what the price effect is, right? The price effect is if I want to increase quantity, a firm must reduce the price on all previous units, thus you lose revenue on those previous units. And if you're like, what? When did we talk about that? Remember when we look at a demand curve like this, and if I had a price point here, and I said we want to increase quantity. The law of demand says if I want to increase quantity, I have to reduce my price. So I am going to reduce my price and go down to here so I can have a new quantity. Well, remember, this area was called our price effect. Well, in perfect competition doesn't have the price effect. And it doesn't have the price effect because in perfect competition, I don't have to, each firm does not have to reduce the price on all previous units. Right? Because I can sell all of my products for one price. I can sell all of my products for one price. That's the key thing behind it. and being able to understand the significance of perfect competition not having the price effect. It isn't as big of a deal in this chapter, but next chapter, the price effect is much more important. But I just highlight right here that perfect competition does not have the price effect because Mr. Darby. That's why it does not have that. Okay, so what I'd like you to do is you can pause this video and you can go in and actually stop this video because now it's time for you to do your check your understanding number 1 and anything else that I have put on the lesson plan for you. All right? Peace out.